Hello and welcome to a brand new episode of ETMarkets Smart Talk, a show where we talk about market trends, investing yarn, as well as techniques on how to become an effective trader or an investor. Well, my name is Shadajan, and then today we have with us a very special guest, Atanuu Agarrwal, who's a co-founder of Upside AI, and we'll be talking about the role of artificial intelligence in investment. Now, Atanuu has over a decade of experience. He has an extensive experience in public and private investing, both in India as well as in the US. Now, welcome to the show, Atanuu.
Thank you, Amish. It's great to be back.
Right. Now, this is the final part of our series where we'll discuss the role of artificial intelligence in investment. Now, in the first part, we talked about AI and ML and how it's really helping investors in a large way, parameters to be analyzed when you're making a buy or sell decision, and how AI is finding whole new meaning in the investment landscape. Now, Atanuu, let's discuss a few more parameters in details. So can the AI system adapt to external changes, such as COVID or a war situation that we are witnessing right now?
I would say that is the primary reason, that is the primary advantage of an AI and ML system, that can be dynamic, right? Where a human manager probably finds it hard to change his or her biases with regards to certain securities or certain types of assets. And AI and ML is able to be, or any technology for that matter, any rules-based system, is able to be ruthless about its decision making, right? Completely rational. It doesn't care what's happened in the past. It cares what it thinks is the best way to make money going forward. So I think the short answer to the question is absolutely, that is the USP of the system, that it is dynamic and it is able to adapt to changing conditions. And the way it does it is through signals, right? Ultimately, you are feeding in price data, fundamental data, market macro data into the algorithm, and all of this shows up in that fashion, right? Again, I want to clarify that I'm talking about Upside AI's algorithm. I don't know what other people are doing in such a large industry. But at Upside AI, we don't use news as an input, right? We don't feed in news events because, in our view, news can at times, it's very hard to separate noise from signals, right? If like when Trump was the president of the United States and he was tweeting about aluminium or about China export ban or some anything, it was hard to say whether it's noise or whether it will change his position tomorrow, right? So news in general is of that kind, right? It's hard to use in a very objective manner. If we try to use it in any fashion, we'll probably end up biasing the algorithm with our own personal human biases. This is happening now, so we should change something in the algorithm and make a certain decision. We don't want to do that. We want the algorithm to be the fund manager. Right. So we do. The answer is yes, it is dynamic, and it is dynamic when it reflects in real number data. So yes, in summary, the main USP of an AI or ML based system or any technology based investing is that it is able to be dynamic and ruthless about its decision making, and sort of be disciplined in the sense that is not tethered or biased by any particular set of events.
Right.
So,
in fact, in fact, a big takeaway for investors would be that if you are on AI ML platform, at least you are able to move away from the behavioral biases that one has. Another important question which usually comes to the mind is how is risk factor mitigated or controlled by the system? I think all of us would want to know that.
Right. So a couple of things that we at Upside AI do, right? So one, unlike a lot of people who use technology in India at the moment or even abroad, we are not a shop that uses any options, derivatives, futures. So we don't have any sort of leverage in our portfolios. Neither do we short any securities, right? So we're a long-only fund that buys a portfolio of securities, and we rebalance that portfolio periodically based on signals from our algorithm, right? So one set of risk mitigation is that since we're a long-only portfolio, our behavior, by and large, follows broad market indices, right? It goes up and down with the market, right? So if you look at us during COVID 2020 or in a backtest in 2008, when the market is down 30, 40, 50%, we also go down with the market, in line with the market. But when we recover much stronger than the market. That is why we generate the alpha that we generate, right? So one risk mitigation is we don't use any leverage of any kind. So in our case, you will not see those flash crashes that people are worried about with algorithms or technology, right? Suddenly the market is nicely up 2-3%, but something has gone wrong in the algorithm and it's down 15% in the day, because it's not possible in our level, because we don't use leverage of that kind. And it's not also possible because our portfolios are very well diversified. So we have risk metrics where, one, we do not trade or buy securities which are not liquid, right? So even within the listed space, we have volume filters where we eliminate any illiquid counters, which we cannot get in and out of, right? And the way to think about it is, you see these securities where there are upper circuits every day and then lower circuits every day, and you basically can't trade the security. So we try to avoid those securities as much as possible. So we eliminate those top type of scripts. We are not interested in investing in those type of scripts. Second, we have a risk mitigation layer where we don't, where any one security is not more than 10% of the portfolio at cost. Right? We let it run, and then when we rebalance, we get it back down to 10%. But when we buy, nothing is at more than 10% of cost, and no single industry is more than 35% at cost. Right? So again, we have multiple risk layers here, where one is, we are not buying securities which are micro caps, which don't have any volume, or which are some operator driven securities, and we also are very well diversified. And third is, we use no leverage. So our portfolios, in the end, the result is that the behavior is similar to the market, and we make alphas in small bucks.
Right. And in quick 1 minute, if you want to describe what is the role does machine learning play in portfolio building?
AI and ML is often used together, so people sometimes don't know the differences, right? So AI is the practice of using computers to behave like humans, right? In many ways and forms. ML is a subset of AI, right? So AI can be used in very many different forms. Bots are AI, robots can use AI. There are many different forms of AI. ML is specifically AI where you're giving the machine data, and that machine is crunching the data and is making inferences on its own. Where you are not telling the machine that if the stock ROE is 20% and PE is 10x, then the stock is a good buy. We are not telling the machine is making decisions by itself, right? So ML, the role of ML is essentially that, where it is able to crunch all the fundamental data, all the macro data that we give it, and is able to draw inferences which are objective and which it thinks will have the highest probability of return, right? So that is why we use ML. And as you correctly pointed out in the first part of the question, where it eliminates all behavioral biases, that itself adds a lot of value, where my or my co-founders' biases are not built into the algorithm, where the machine is making objective decisions. Yeah, and of course, the second part is it's able to crunch all of this data, which is not humanly possible, and run millions of iterations and come up with the optimal portfolio. So yeah, that's how we use them.
Right. Well, on that note, thank you, Atanuu, for your time today. And well, that's all for now, but do stay logged on to ETMarkets.com for more on news, business, and economy. Again, thank you so much for your time.